Hello, Viral.
Hello, hi.
Hello. So,
Can you hear me clearly, or?
We can hear you pretty clearly. Is that true at the back? Can you hear it well? Can you see your audience?
Yeah, I think so. I think I can see
Right.
most of them. I can see some people too. Yes.
Okay, so I'm Alex McNeil. I will chair the session. I think you have to tell me when to advance the slides at this end.
Yes, yes. Yeah, I'm going to just bring up my own slides here because I think I don't see slides there. So.
I'll have the number.
Yeah. Well, meanwhile, I'll do the introduction. I suppose I don't say it's my pleasure to welcome Viral because he's over there and we're here, but it's my pleasure to introduce him, Viral Acharya from New York University Stern School. You can see the title, Financial Sector Health, since 2007. Are we ready?
So thank you everyone for being here, and sorry for this sort of format. I'm leaving for India tomorrow evening, so it was a little tight to fly to UK and then get back here and then fly off to India again. So I thought what I'll talk about today is something very applied, because we do a lot of research always, and academics love to build new models for everything, and some models are very interesting because they are insightful. They are trying to capture some new microeconomic phenomenon. They might be capturing some new facts that we've discovered that haven't yet been there in models. But I find that very often when one has to ask the following question, a question of the following type, like how do you assess the global financial sector health since 2007? Suppose we were just asked a question like this. Then when we have to provide an answer to something like this, we often have to tie our hands down because we need something that's simple. We need something that can be measured reasonably over time. And we need something that's easy to communicate. This could be a question posed by a policymaker, it could be a question posed by someone in industry, it could even be a question posed in a lunch roundtable that we might all be sitting in. And so I thought that I would try to show how something that we've been doing in research, but that has this property that it's simple, it's easy to apply, it can be calculated over a period of time, and then use it to form some thoughts about how the global financial sector health looks like, with a focus on United States, Europe and Asia, and what that tells us about things that have been going on in these countries in terms of financial sector reforms, emerging risks in these countries, etc., etc. So just to be clear, my goal, I don't think I'll be able to illuminate you with something that's very profound or deep in this talk. Maybe you walk away with something very interesting, but I wanted to do something very applied, which is to give an example of how something that's academically well-founded, or at least conceptually has some academic merits, but can still be applied in a very simple way to answer questions that we might come up with on an everyday basis. Now, the work that I'm going to talk about, it's actually implemented on a website at NYU. It's called the NYU Stern VLab, as you see it there. It's called VLab, Volatility Lab, .stern.nyu.edu. It's run by Rob Engel, and some of us as the other academics are part of this Volatility Lab and Volatility Institute. So we can move to page 2 now. As I said, I want to focus on how have financial sectors in different regions of the world behaved in terms of their vulnerability to a future crisis since 2007. Okay, so I want to be clear about this question. I'm not asking the question how likely is a future crisis. Okay, that's an interesting question in its own right, but I'm not going to try and answer that question. I'm only asking the question, suppose there was a future crisis, then how vulnerable are the various parts of the global financial sector. I think the exercise of trying to predict crisis is, in my opinion, a lot harder than knowing how a financial sector will fare in a crisis. I think, to just be a little facetious about this, Mervyn King, the former governor of Bank of England, he always says that the best indicator of a crisis is the crisis itself, which is that it's very hard to get it ahead of time. That the best early warning indicator you have is that you are in a crisis right now. So, and I'm going to focus on United States, Europe, and Asia just because they are large. They are probably more relevant for the global economy and the global financial sector, and so on. And I want to do all of this using a measure called S-risk, which we tried to explain in an AER paper and proceedings paper in 2012. And it's a measure of vulnerability of a financial firm to a future crisis. And it's going to be something that can be aggregated up. So S-risk is going to be how much I will be short of in terms of my equity capital relative to some prudential benchmark, as I'll explain, in a future crisis. So it's going to be in dollar or euro terms, and therefore it can be added up across different financial firms, and which is going to be useful because then you can aggregate this measure across financial firms and get a sense of the health of that particular financial sector, or add it up across all firms in the global economy and get a sense of the global financial sector here. And just to preview the results, I'm going to show you three key findings which I look at this website fairly often. So that's one other interesting, useful thing about it. So when I'm not doing anything, I just go to this website, and sometimes, like just like the surf web, I go to this website and I start looking at graphs that we provide there and try to make sense of what's happening to the numbers, why they might be moving the way they are, and try to form some intuition for what may be happening. And what we find is that the health of the global financial sector, measured in these terms as vulnerability to a future crisis, has had a very diverging pattern between these three regions. In particular, the US financial sector has been deleveraging steadily, in the sense that its vulnerability to a future crisis has come down substantially because it has reduced its leverage, or it has recapitalized itself fairly substantially. Europe, in contrast, has had a fairly uneven recovery since 2007. It looked the worst in 2008-09, like the US. But in 2011, in fall of 2011, the health of the European financial sector in terms of vulnerability to a future crisis looked as bad as it was in 2008-09. And so I interpret this to mean that Europe has actually had two significant crises, in my opinion, or two significant periods of severe distress in the financial sector since 2007, not just one as in the United States. But things in Europe look somewhat on the mend, as I will try to show you. This may be ECB reforms or other structural reforms that are taking place, and some recapitalization by banks on their own. In contrast, and this is what I find the most intriguing, and maybe it gets the least covered because, even though we cover China a lot in what we do, academics pretty much still don't study China. I think we see a handful of interesting papers in a year. But what we find is that the Chinese financial sector has actually been leveraging up in a very, very massive way. And it does seem to pose some questions as to whether some important vulnerability in the global financial sector for future actually might be in China. Even Japan I'll show you, but China seems the most interesting here. Okay, and then if there is time, I'll have some conjecture on what might be explaining some of these differences. Okay, so we can move to slide 3. So I've already given you the preview, but I would like to talk about S-risk, which is a measure of capital shortfall of a financial firm in a crisis. And I'm going to think about it as a measure of systemic risk contribution of a firm, because our view is that a financial firm creates systemic risk or financial sector as a whole creates systemic risk if it becomes undercapitalized in an adverse scenario. If there is a massive common asset shock such as to house prices or reduction or growth in the global economy, and if the financial sector can withstand that shock in the sense of maintaining good market equity standards, then they will function normally even though there has been a bad shock, and it won't be systemic risk, there won't be firms failing, there won't be transmission to others in the financial sector, there won't be transmission to the real sector. But if it becomes undercapitalized as a whole, and I think this point is important, which is that you want to add these capital shortfalls up because a financial firm one financial firm may not be doing well, but if others are, they might be able to pick up the intermediation that is not being provided by the distressed firm. Okay? And then this aggregation of this measure, the capital shortfall of different financial firms, when we aggregate it up, I'm going to think of that as a barometer of the financial sector health, which is if there was an unexpected large recession or a large collapse of the global economy and stock markets, how much capital will this financial sector need to continue to function normally? Okay. So let's move to slide 4. I won't spend too much time on this, except just highlight that for a lot of people, systemic risk is not the way I have described it to be. Systemic risk to them is not about what happens in a common asset shock to the world. For a lot of people, systemic risk is if one firm gets into trouble, how it's going to spread its problems to others. So it's more of a contagion or an interconnectedness view of the world. Now, I don't deny that that's sort of another interesting way of thinking about systemic risk, but I come back to the point I just made, which is that my own sense is that if JP Morgan was to fail in isolation, it's just not a problem. Its interconnectedness is not a problem. It's going to be great for other firms in the financial sector. Suppose JP Morgan collapsed because of the London Whale problem, the fraud that happened in some of its trading books. Suppose it had collapsed at that point, Bank of America and Citigroup and Deutsche Bank couldn't be, they would be celebrating by opening champagne that evening in their branches, and their headquarters. There could be nothing better that could happen to these banks than JP Morgan collapsing out of its own problems. But what would be a problem is if JP Morgan collapses and Bank of America, Citi and Deutsche Bank are in pretty bad shape as well at that point of time. They actually don't have enough capital to take over the businesses that JP Morgan is buying. And now the fact that JP Morgan is a swap counterparty and might be defaulting on some of the positions becomes a problem because they don't have capital to actually take on extra losses in the first place. So it's my own view based on theoretical research and otherwise that contagion is a problem only if the system as a whole is actually weak in the first place. I can't think of a single crisis that has come about because there was no common asset shock somewhere and just that one entity somewhere collapsed because of its own idiosyncratic problems and it ended up bringing everyone else down. Now, of course, if you just have one financial firm in your entire country or if you just have 4, then of course one firm failing may not be idiosyncratic anymore. But I think that's not the kind of countries and the global financial sector we are talking about here. So I like to think of our view as at a minimum complementary to the contagion view, and I like to think of it as a tsunami view, which is what if a tsunami comes and hits the global economy and the global financial sector? Do you have adequate capital to actually withstand this shock or not? Okay. So we measure this measure as risk econometrically based on market data on equities and balance sheet data on liabilities. We update it weekly on our website for US and global financial firms. We currently do this for about 1,200 financial firms, and we call this measure as risk. Okay, and we have a lot of people working in this. We also have some people who are supporting this. Okay, if we go to slide 5, this is really the only conceptual slide in this talk. Rest is just going to be numbers and figures. So how do we measure this S risk? So S risk for a firm I at time t is the expectation today at time t of the capital shortfall that this firm I will suffer from in a crisis over some time period between say t and t plus n. Okay, so it's a conditional measure of capital shortfall, but its expectation conditional on the crisis is going to be taken today. Okay. So how do we measure capital shortfall? So suppose that there's a crisis at time t plus n. In general, it could be happening between t and t plus n, but just to make things precise, suppose it is at the end of 6 months from now. Then we want to ask the question, in 6 months from now, what will be the size of the balance sheet of this firm? And how much should I be asking this firm to hold as equity against that size of the balance sheet? So we're going to try and project the debt and equity at t plus n. So the sum of debt and equity, or think of it as equity and non-equity liabilities. That's the total size of the balance sheet. And we're going to require that a certain k percentage of that be in the form of market value of equity. Okay, and I'll come back to this point that we are using market values of equity. Okay, so the required capital at time t plus n is the total size of your balance sheet at t plus n times k. Say it's 8% or 5.5%. So that's the required capital. But then I have to answer how much capital will you have at t plus n. That's equity t plus n, which is given your equity today, I'm going to try and project how much of your market value of equity will remain at time t plus n. The gap between these two, which is the capital I require you to hold at t plus n, which of course I have to project as well, and the capital that you're going to end up with is our measure of the capital shortfall of this firm. Okay, now all of these things of course have to be taken into expectation and with information today. So we make some simplifying assumptions. An important assumption we are going to make is that the non-equity liabilities today are going to be the same as the non-equity liabilities in future. Okay, now this is not necessarily a great assumption. There are a lot of off-balance sheet liabilities such as lines of credit that could get triggered. There could be margin calls on derivative contracts that could become relevant. But to apply a method like this for 1,200 global financial firms, we simply don't have enough data to really project what your debt liabilities are going to look like in 6 months from now, conditional on being in a massive crisis. Okay, so we can't do that. So we're going to make the simple assumption that your non-equity liabilities are going to stay the same. Okay, we're just going to measure them at face value because the idea is that capital has to be enough to pay off the creditors in full. Otherwise, there's going to be distress, bankruptcy, and so on. Okay. And what about equity at t plus n? So here we are going to do some econometrics using dynamic conditional volatility and dynamic conditional correlations work that Rob Engel has been working on. I won't get into the specifics. You can look that up on the VLab and in his dynamic conditional beta papers if you want. But the idea here is that if my equity value today is equity IT for firm I at time t, we are going to project its loss conditional on a crisis, which is this term LRMES. That's the long run marginal expected shortfall of firm's I equity. So long run because it's over 6 months, it's not just over a day. Marginal expected shortfall because it is not the expected shortfall in the firm's own worst outcomes. It's the expected shortfall conditional on a crisis. How much of my equity do I lose in a crisis? Okay, so then that expression for S risk simplifies to this. It's K times debt minus 1 minus K times 1 minus the loss rate on equity in a crisis times the market value of equity today. So market value of equity today, it's easy to get for all publicly traded financial firms. So this method can only be used for publicly traded financial firms. LRMES we are going to use using some historical data by building dynamic conditional beta models on it. K is something, a parameter that we are going to choose just the way Basel regulators say 4% is enough or 6% is enough. We are going to take the stand that the capital you require is 8% market value of equity relative to your balance sheet because of some accounting differences on how derivatives are treated in US and Europe, we are going to assume this ratio is 5.5% for European firms which report under the IFRS and not the US GAAP accounting. And the non-equity liabilities we are going to update on a quarterly basis from the balance sheet filings of these firms. Now, as you can see, S-risk depends of course upon size. If I just scale everything up by a factor of 2, S-risk is going to become 2 times larger. Okay? It's going to depend on leverage because it depends on your debt today relative to the market value of equity today. Okay? So it depends on your quasi-market leverage, book value of non-equity liabilities to market value of equity. And it depends on risk. This term LRMES is a reduced form way of capturing the risk in a very top-down risk measure of the balance sheet, because it says conditional on a future crisis, what's going to be the percentage loss in my equity. Okay, so it captures how vulnerable are my business activities to the business cycle downturn. Do I have assets which are going to make losses in a downturn like mortgages, etc. Or do I have a relatively safe portfolio of assets and non-cyclical assets, in which case my long-run marginal expected shortfall will actually not be that large. Okay, so let's just take a concrete example to make things precise before we move on and start looking at what this shows. Okay, so at some point in the past, I think this might have been in 2012 perhaps, Bank of America had a market cap of 141 billion, its non-equity liabilities were $2 trillion, okay? So its leverage ratio, which is debt plus equity by equity, was about 15, okay? Now, we require a leverage of 8%, K of 8%, that is equity to assets. So K of 8% implies a leverage ratio that we can allow of 12.5 because it's 1 over K. So based on its ratio of 15, Bank of America is already undercapitalized, which is that it's not holding enough capital even if I was to ignore its losses in a crisis and simply apply the K of 8% today. Now, of course, if we have another crisis, which we are going to assume throughout, is a 40% collapse in the aggregate stock market. Since it's US, sometimes we do it with US equities, but by and large, everything I'm going to show you is for the global stock market as a whole. So suppose there was a 40% collapse in the global stock markets over the 6 months, we estimate using a dynamic conditional beta approach that Bank of America will fall by 50%. Okay, so it's whatever is the market fall, its own equity magnifies that collapse by a factor of 1.25. Okay. Now, of course, that means Bank of America will be only left with $70.5 billion in a crisis. Okay, so that's $141 billion times 1 minus 50% of this LRMES. But we're going to assume these $2 trillion of non-equity liabilities are still going to remain. So given that in the crisis it needs to be at a leverage ratio of 12.5 or a K of 8%, we estimate that Bank of America will need an additional of $91 billion in the crisis to recapitalize itself to function normally. Now you might say, well, how did this 8% come about? We just made a pragmatic choice. We chose 8% because JP Morgan, which was a healthier bank in 2008, even at the peak of the crisis, maintained a market equity capitalization of 8%. How did we come up with 5.5% for Europe? Because HSBC, which reports under the IFRS, maintained a capitalization of 5.5% both in 07-08 and in 2011 crisis as well. Okay, so that's just an illustration. Okay, so I have a little bit down here. I'm sorry, I forgot to move the pages. I don't know if we were on page 6 for the Bank of America example.
Yes, we're on 7 now.
Sorry?
Yes, so I've gone on to 7 now.
We're the credit agricole page.
Credit again.
Credit
Okay, great. Great. So I think we can skip 7, we can skip 8, and we can go to 9 straight.
Okay.
Okay. So I want to now use this measure S-risk, as I said, as a barometer of the global financial sector health. And the way I think of this measure in very simplistic terms is that in order to, so when my child is not well, the first thing I think about is to measure the temperature of the child. Now I know that a thermometer doesn't give me everything about a child's health. It doesn't give me any deep understanding of what is or is not going on with my child's health. But I still need to do that as the first thing to know whether I need to investigate further and dig deeper into what exactly is going on. And that's exactly how I personally use this measure. I use this measure as a sign of red alert that somewhere in some parts of the world, estimates of future capital needs in a crisis are increasing a lot, and now we need to understand why that may be happening. Okay, so if we go to slide 10, this figure shows you the aggregate S risk in dollar terms for different parts of the financial sector. So this is in millions. So the highest number up there is 2.5 trillion, and the number at the bottom is 0. So these are capital shortfalls aggregated across publicly traded financial sector firms in United States, Asia and Europe, and separately just for China because I want to highlight it as a peculiar case. And these numbers go from 0 to 2.5 trillion. Okay, and you can see already the big messages that I was trying to give earlier here, which is that if you look at the top line, the very top line, that's Europe. So that is the line always above the others pretty much for most part. And you can see here that this number from around $500 billion at beginning of 2007 reaches a peak of about $2.25 trillion at the peak of the financial crisis around Lehman Brothers collapse and so on. It comes down as there is some stabilization through various packages in the world, but you can see that in 2011, beginning January 2011, it starts rising pretty sharply again, and in fact reaches a peak pretty close to $2 trillion in the fall of 2011. Okay, now this is saying that we are not changing the probability of the crisis here. We are still saying if at any given point of time there was a 40% further collapse in the stock market, what would be the capital shortfall of the financial sector? Okay, and so my reading is that fall of 2011 for Europe was as big a moment as the Lehman Brothers collapse was. Its financial sector looked as undercapitalized at that point as in fall of 2008. And you can see that since then things have come down, but even now, if you look at the capital shortfall estimates in a future crisis for Europe, the number looks still as high as say March of 2008 around Bear Stearns or something like that. Now in contrast, if you look at the United States, which is the red line, you can see that it reaches its peak of about $1 trillion at around Lehman Brothers. Since then the number has come down. Yes, United States also experiences a peak in its capital needs in fall of 2011, but that peak is quite shy away from the first peak. And more importantly, if you look at the current capital needs for United States, they are almost the same as they were in January 2007. So, at least in terms of a time series, the United States financial sector has recapitalized itself or deleveraged itself to a point where it was in terms of capital needs in beginning of 2007. Now sometimes when I show these numbers, people say, these are humongous, these make no sense. Okay, are you serious that Europe, to be well capitalized, needs $1.5 trillion of injection into its financial sector? Now, I agree, it's a big number, but the only way I have to benchmark is the following point. Okay, let's take US at Lehman Brothers point. Okay, our estimate says that the United States financial sector needed $1 trillion of capital. Okay, now let's try and put that number in perspective. What was the size of the recapitalization package in the United States? Just TAR, which was the capital injection into the financial sector, was $750 billion. And on top of that, there were guarantees provided by Federal Deposit Insurance for issuing bonds. They increased the deposit insurance limit. and the Federal Reserve started all sorts of additional liquidity facilities provided cheaply to give funding to the financial sector. So my sense is, based on this number, that $1 trillion of capital need in fall of 2008 for the US was actually not a bizarre number. It's not an egregiously large number. It is actually the kind of package that the US put together, $750 billion. Yes, I see a question in the back here.
I'd like to know how many banks are in the aggregate measure of Europe and China.
Yeah, so I probably have an appendix down there. Let me go down there and show you. So it varies a little bit from year to year, but for Europe, it's anything from 350 to 400 publicly traded banks and financial firms. So later on, if you want to look at it on slide 29, which is an appendix slide, I have the total number of firms per region, year by year.
Viral?
Yes, please.
I was wondering what capital requirement did you use for Asia? And also, are you really comfortable using such a big difference, 8% versus 5.5% for US and Europe?
No, these are both excellent questions. So for Asia, we are using the same benchmark as the US. And because, so let me explain a little bit why the US and European difference has been made. It's because the netting of derivatives under the US GAAP is relatively flexible, whereas netting of derivatives under Europe requires that netting be allowed to happen pretty much under all circumstances. So if the language of the derivatives contract don't allow netting in some states of the world, or it's vague, then IFRS accounting in Europe will not allow the netting. Now what that does is that the large dealers in Europe, like the large French banks or the large German banks, who have significant derivatives positions, their balance sheets in IFRS can be twice the size because there are derivatives on assets and there are derivatives on liabilities, and they're not getting netted out. So the balance sheet of Deutsche Bank looks about twice the size that it does in the United States. Now, so how do we benchmark 8% versus 5.5%? There's no easy way, because unfortunately most European firms don't report US GAAP. So we can't convert everything into a US GAAP analysis. But Deutsche Bank, because they always want to compare themselves to American banks in terms of their health, because they want to be ready to raise both wholesale funding as well as equity in the United States if needed, they do report their US GAAP balance sheets since they moved to IFRS, I think in 06-07. So for Deutsche Bank, we have both, and we basically came up with this adjustment of 8% to 5.5% based on Deutsche Bank as an example. This is not to say that it makes sense for everyone, but that's the best we can do because no one else is actually reporting the US GAAP balance sheets. But let's look at Asia here now.
Just a quick remark, we should keep our eye on the clock. We should aim to finish on the hour, roughly speaking, give or take 5 minutes.
Yeah, sure. Yeah, I'm not going to go through all the slides, so I think you're welcome to look at some of the other things, but it should be relatively quick now onwards. So look at Asia and China in particular. So Asia is the gray number. You can see that it's just a monotone upward, pretty much monotone upward line. And China, which was basically zero until the fall of 2008, which means that its firms were actually capital surplus. Chinese financial firm needed no capital as per our calculation until Lehman Brothers collapsed. Then it increased a little bit. But since 2010, these numbers for Asia as well as China in particular, and you can see that Asia and China are almost moving in lockstep, like one for one. That the Chinese financial sector's capital needs have grown to be particularly large. And while US has been deleveraging, Europe is flat or somewhat deleveraging, China and Asia as a whole have been in a leveraging cycle since 2010. And I'm going to come back to this point a little bit later. Now, one thing that's not so interesting about these aggregate S risk numbers is that, okay, for Europe, I have more financial firms, it's a bigger financial sector. So is it really surprising that it's always above and has a higher financial need? Yeah, it's bigger balance sheet, so it has bigger capital shortfalls. So it might be useful to scale all of this by some measure. So we're going to use the GDP of the countries in order to get a sense of how significant are these shortfalls. So if we can go to slide 13. Slide 13 shows the S risk that is normal, sorry, not slide 13, sorry, that's slide 14. Slide 14 shows these S risk numbers which are normalized by the GDPs of the country, by the regions. Okay? And what you can see here then is that the peak United States need was between 6 to 8% of the United States GDP. The peak European financial sector need was around 11 to 12% of GDP. In 2011, it is still around 10% of GDP. And for US, the number is now very small. It's back to 2%, whereas for Europe, it's around 6%. And interestingly, you can see that China has now basically caught up from being zero in fall of 2008 to around 6% of GDP. Relatively to where Europe is. Now, why do I like scaling by GDP? Because historically, whenever you get a financial crisis of this magnitude, and I didn't say this, but the reason why we chose a 40% market collapse over a 6-month period is because we wanted to shock the system to a Great Depression or a Great Recession. And these were the biggest collapses we observed over a 6-month period in the global stock market, 40%. And effectively, you can think of our approach as just like a stress test, but it's a market-based stress test. Our stress scenario is a 40% crash in the global stock market. We are trying to project what the capital need is in a crisis by projecting how much of equity loss will you first make in that stress scenario. So it's like a stress test, but because we are academics, we don't have access to detailed asset data. So we are doing something very top level using risk information from equity and balance sheets. Okay, so let me now jump to slide 16 to show you a little bit about which countries are actually contributing the most. Okay, so slide 16 shows that perhaps not surprisingly, United Kingdom is up there. Switzerland is up there because we know that UK and Switzerland have very large financial sectors relative to their countries. But interestingly, the country that is going to be as per our estimates, need the most capital for its financial firms in a crisis is actually France. And I find this particularly interesting when you scale it by GDP on the next slide, which is slide 17, which is that the estimate of the French bank's capital needs in a future global crisis is of the order of 13% of the French GDP. As I said, UK and Switzerland are up there, not surprising, they're very large financial sectors. And these countries have been much more stringent with their banks in capital raising. And yet, because their financial sectors are so large, scaled by GDP, the needs are still going to be quite large. But for France, in spite of the fact that we don't think fundamentally that this financial sector is that large related to GDP, we find that because the leverage of the French banks is very large, and perhaps it's just the policy that they've adopted that we're going to let our banks not have much capital so that they can operate at high leverage for a variety of reasons. But I think it's kind of worrying that the French economy is not looking great as a whole, and that the French banks look the most vulnerable both in terms of aggregate dollar needs as well as in terms of the needs relative to GDP. Okay, now if you look at Asia, so let's go to slide 18. Not much surprising here, China and Japan dominate the dollar numbers. If you go to slide 19 and look at it based on GDP, Japan is much higher in terms of GDP, even though its aggregate dollar number is very close to China. But China is also about 6% of its GDP in terms of its needs, and we think that these are sort of substantial numbers. Okay, so what I want to do next, besides leaving some time for questions, is to dig a little bit more into China. Okay, so let's go back to the slide on S risk, which is the slide 5. Okay, so one nice thing about having a simple measure like this is that not only can we actually produce it and track it consistently over time, another advantage is that if I take any two time points of on any of those time series and I compare the S risk numbers, I can decompose that number to know why did the S risk change. Did it change because the non-equity liabilities have changed? Did it change because the contribution from 1 minus K times equity, which is the market value of equity contribution, has changed? Or has the risk term changed, which is 1 minus K times LRMES times equity? Okay. So suppose S risk goes up, I can ask the question, has it gone up because debt liabilities have gone up? Has it gone up because market value of equity has gone down? And has it gone up because the risk measure LRMES has gone up? Okay, so I can provide a very simple decomposition. So now this is going a little bit beyond just taking the temperature of the child. Now I'm trying to understand a little bit, trying to use it as a diagnostic and thinking a little bit harder about which part of the balance sheet might actually be causing an increase in the S risk measure. Okay, so then let's go back to the China slide, which is slide 20, and let's jump to slide 25. Okay, now China is a very interesting financial sector. Its commercial banking is for most part state-owned. And the top 5 banks that you see there, Bank of China, Agricultural Bank, China Construction, ICBC and Bank of Communications, these are the 5 largest state-owned banks in China. And you can see that out of the total capitalization needs of around $500 billion, the top 5 banks basically contribute 70 to 80% of this. Okay, so we are really talking about these 5 banks when we talk about China. And next, on slide 26, what I show is a decomposition of the change in S risk for China using these approach that I told you. So this is one of the functionality that we have on our VLab site, where you can pick 2 dates. So here I have picked beginning of 2010 and October 2014 when I produce these slides. And you see S risk T-1, which is S risk at the beginning of 2010, and you see S risk T, which is in October 2014. Now you can see that I think pretty much across board, except for one bank, the S risk numbers in beginning of 2010 are negative. Okay, which is that our estimate of capital shortfall for these firms is that there is no capital shortfall. In fact, these firms would have been in a capital surplus had there been a 40% global market correction. In contrast, you see that all the numbers as of October 2014 are positive and significantly so. So if you look at the change in S risk, which is the third column, delta S risk, you can see that for the top 4 banks over here, these numbers have gone massively. Take the example of ICBC, which has gone from having a capital surplus of $71 billion in a crisis to a capital shortfall of $77 billion. So that's a capital change in S risk of about $150 billion. Okay, and where is it coming from? So the next 3 columns are very interesting because they show you the decomposition of these changes. It explains where does the change in S risk come from. Has it come because the non-equity liabilities have gone up, so K times debt has gone up? Has it increased because 1 minus K times equity has gone down? In that case, the number would be positive. Or has it gone up because 1 minus K times LRMES times equity has gone up? And if it has gone up, the number would again be positive. So in fact, the rightmost column, delta S risk, shows that it's not that the downside risk exposure has gone up. Okay, it's not the LRMES which is causing the S risk to go up. It's not the case that they've suddenly loaded up on European assets, and therefore, because Europe is right now the biggest global risk, somehow their downside risk estimates are very high. No, the risk has actually remained steady or even come down to an extent. Yes, the market value of equity has not looked as great. So the second last column, which is change in equity, is contributing. The fact that your equity right now has gone down in value compared to 2010 is contributing to the increase in S-risk. But the biggest contributor to S-risk is the third column from the right, which is the change in non-equity liabilities. This is a simple balance sheet number. What do my debt liabilities look like? And this says that K times the debt liabilities, so 8% times your debt liabilities, have gone up for the top 4 banks by, this is basically about $400 billion. Okay, now that's 8% times that. Okay, so that is a huge magnification in the debt liabilities of the Chinese financial sector. And our understanding is that this is actually an underestimate, because the Chinese banks in the last 3 years to 4 years especially have been raising a lot of off-balance sheet debt by setting up what are called as wealth management products. So these are the equivalent of the money market funds in the United States. To keep their leverage off balance sheet, they are raising a lot of debt liabilities off the balance sheet, which is not even recorded in these debt numbers that we have over here. And therefore, what my sense is that China has been on a massive leverage boom as a conscious fiscal policy to stimulate the economy since 2009, 2010, as the global growth was weakening. So let me conclude and leave some time for questions. So my assessment based on this figure is that the global financial sector health looks very uneven. So I'm on the last slide now, slide 27. And interestingly, there are diverging patterns here. The US financial sector appears to have been deleveraging steadily. The TARP recapitalization, the stress tests, which are being done every year and have become a binding capital constraint on banks, and other recapitalization measures appear to have worked well, at least based on this measure. Europe, in contrast, is sort of more shaky, looks as bad in 2011 as in 2008. Even now, it looks much better than 2011, but only as good as at the time of Bear Stearns. So, it still has some way to go in our view in terms of deleveraging and recapitalizing the banks. And one interesting point to make is that even though Europe did put in place significant stabilization packages after the collapse of Lehman Brothers, unlike US, there was no significant TARP. There was no significant recapitalization of the European banks. Most stabilization measures in Europe were in the form of liability guarantees or asset guarantees. Okay, so that prevents a run on the bank, but it doesn't necessarily make the bank more stable in terms of its equity buffer, the capacity to bear losses privately rather than impose these losses on taxpayers in a future crisis. And in contrast to both of these, Asia has been leveraging steadily, especially China. Debt-based stimulus seems to be the main culprit, which is a conscious public policy to keep lending to municipalities, keep continuing to prop up the housing boom. And why do they have to do this? They are doing it partly because they want to sustain the high growth numbers, because they've created a lot of rural employment through this public programs, which are all being administered through the state-owned banks. So state-owned banks are of course the vehicles to deliver the public policy of China, which is to create massive employment in various rural areas and economic zones. But as I stressed, we think the true risks are understated for two reasons. One reason I did not state before, which is that these are state-owned banks. Even their equity is likely to be building in some value of the government put option. So the equity values that we have are probably already overstating the true equity value because of the government guarantees. And then there's a significant amount of off-balance sheet liabilities which we haven't even factored into account over here. So let me stop there. There are some appendices. One is on sample selection, and then there is another appendix which shows you how would our measure have done historically in 07-08 crisis. Would you have come up with the right rankings of which institutions failed, which institutions needed bailouts and things like that. But let me stop there and take some questions if there are any at this point.
Okay, well, thank you very much.
Okay, so I'll take that question.
Alistair, two quick questions. One was, do you adjust the beta for changes in the leverage of the banks? Because as there's been recapitalization, you'd expect them the betas to fall, and do you factor that in? My second question is about growth opportunities. I'm thinking that the US banks, the US economy is relatively strong at the moment. There are lots of growth opportunities. If there's a financial crisis and it stalls, you'd expect a big equity market effect. Europe is already in stagnation, so I'm not sure crisis should be as big a downward movement in equities, given that the growth opportunities aren't there to be lost. So maybe it's more like a 20% rather than 40% for Europe.
Yeah, I think these are both very good questions. So the first question is just sort of a descriptive one, so let me just answer that, which is, so we can't update the debt liabilities until we get the new quarterly filings of the banks, the non-equity liabilities. But of course, they are updated as soon as we get. So every day we have an engine that's running on Bloomberg to pick up the new balance sheets that become available. And the ones that become available, we are using the new non-equity liabilities numbers. Market value of equity is getting updated every week. These numbers get updated on our website weekly. So if you recapitalize, you reduce your debt, and that expands the equity of the firm, that's going to be captured automatically. If you receive some government capital injection, that will also be recorded as and when the non-equity liabilities are repurchased and recorded in the system. I think the second question is very, very interesting. So I think the way I think about your question is the following, and let me use the word reverse stress test. So because we want to be able to compare every number that I show you, I always want to condition on exactly the same event. Because if I condition on different events for US and Europe, then they have different probabilities of occurrence. And then I can't really compare these numbers very well, at least not their magnitudes. So when we do this reporting, we are always focusing on the same stress scenario. It's sort of like why the European regulators use the same stress scenario for all countries, even though Spain and Italy might be in a much weaker situation right now than, say, Germany. Because otherwise the capital numbers, the shortfall numbers that they come up with for German and Spanish and Italian banks won't be comparable, really. It's a different stress test for the two of them. But you could ask a different question than the one we have asked, which we are actually doing some work on, which is a reverse stress test. So suppose you take our S-risk number and scale it by the GDP. And suppose I take the view that whenever this number exceeds 5% of GDP, quote unquote, that's stress. Okay, so because the US Lehman, post-Lehman needs were about 6 to 8%, let's say 5% of GDP is like a threshold. So now you can ask the question, what collapse in the global stock market will I need to produce a capital shortfall of your financial sector that is at 5% of your GDP? And you're absolutely right, which is that for Europe, this might just be a 20% shock. And now, because we have the dynamic distribution of the global stock market price evolution, we can actually calculate how many parts are there in the next 6 months over which the European stock market collapses by more than 20%. And now this even becomes a measure of a crisis or a measure of stress in the financial sector. We can actually calculate the probability with which we estimate that the capital needs of the financial sector will exceed 5% of GDP in the next 6 months. So I think we are trying to do this work. We haven't completed it because once you do something like this, it starts looking like an early warning indicator. But then we have to go back and do a whole historical analysis of how is this early warning indicator working? Is it really picking up the stress episodes and things like that?
Another question. First time I saw was Phil again.
Hi. I have one comment. I believe that in China they've changed within the last 5 years the accounting for the funding of the wealth management products, and more that has to go on balance sheet now. So that may be part of the increase. The other thing is in China they have a huge shadow banking market of trusts, which are like wealth management products that don't go through the banks at all. I was wondering if you tried to incorporate that at all in your analysis.
Yeah, so not in this analysis, but I'm currently doing some research with Professor Jishu Yang at Tsinghua University, and we've actually got detailed bank level data on each wealth management product they've issued through their own trust in the market, I think from like 2005. And we actually do find that the stock market reaction of the banks is actually reflecting these off-balance sheet liabilities. So the day, for example, ICBC comes out and announces stress in its wealth management products, these off-balance sheet vehicles, you can look at the negative market reaction of other banks on that day, and you see that in the cross-section, the banks that have more off-balance sheet liabilities using this data that we have now are indeed the ones that are suffering bigger equity collapses. So I entirely agree with you that the shadow banking stuff is very important when we are not capturing it directly in the debt liabilities number, though we might be picking up the risk that is coming from it because we are relying on the market value of equity numbers. Now, in the last couple of weeks, there have been some important reforms in China. One has been the more explicit distinction of deposit insurance being for bank deposits and not for the shadow banking liabilities. Perhaps there's going to be some greater mobility of foreign capital with, the reforms that they've undertaken for the equity markets. So it's possible that, in fact, my sense is that even easing the access to capital into the Chinese banks might actually stabilize their equity quite substantially, because right now it looks a very closed capital system as far as their capital raising goes. But suppose a Chinese bank gets into trouble, and there would be some banks in the world that might have an interest, if they were allowed to remain as a private bank, that would want to go in and pick up some important branches or businesses of these Chinese banks. In fact, I have been surprised how little capital has moved into Europe, in spite of having banks that are weak for acquisition. And I think part of the problem is because I think we haven't acknowledged in Europe that our banks have a significant problem, and many of them should actually be sold off to better capitalized banks in the world.
Okay, well, we'll take one final question officially.
So you didn't talk a lot about the methodology used to project these quantities 6 months forward, which is a difficult exercise in itself. But if you think of how this intertwines with the cyclical nature of market variables, then if you suppose you're in the increasing phase of a cycle, so the banks are leveraging up, and so any time series model would pick up this trend. So both debt and equity are increasing. Now, if you in your model you project forward the equity values 6 months forward, so if any model which picks up this trend would give you that the equity in 6 months will have a higher value. However, you freeze the debt at time t, so you do not do the same projection for the debt. So then it seems that you get an indicator that is pro-cyclical. It will be tied to this cycle, and this brings me to the more fundamental issue. I mean, we had a talk earlier this week, a talk of Tobias Adrian. He was actually looking at another point of view on all these things. He presented a model in which, if you look at how the business cycle intertwines with capital constraints, then actually what you see is that any indicator that is based on current values of past values of market variables, since it's going to use implicitly or explicitly as input the market price of risk, it's going to give you lower values of systemic risk indicators when the market price of risk is low, and otherwise, so it's going to be inherently pro-cyclical. And it seems to me that there is this feature here, and in particular, there is this aspect of the projection that's inherent in the way you calculate it.
No, that's a very, there's like maybe 5 or 6 questions in there, but maybe I'll try to address them very quickly. So first, there is an inherent pro-cyclicality in anything you do with market data. So this I totally agree. But I want to stress that there are 2 components in our methodology that actually counter that pro-cyclicality. One, a 40% collapse in the stock market is much more likely at the time of collapse of Lehman Brothers than in beginning of 2007. but we are always using the same stress scenario. So volatility at beginning of 2007 will imply that a 40% global market correction is like almost improbable. Whereas when you are in Lehman Brothers, volatility is so high that a 40% market correction is not that unlikely, even a further 40% market correction from where we were at Lehman. So the stress scenario being constant over time is actually a counter-cyclical feature of the methodology. The second feature that is somewhat counter-cyclical is that we are not using simple models of volatility. We are using a dynamic model of volatility that Rob Engel has developed, in which volatility is always mean reverting. So if volatility is at 10%, the model recognizes that the volatility is actually going to be higher over the next 6 months than it is right now. If the volatility is very high, say it's at 45% like after Lehman, the model recognizes that in 6 months this is actually going to come down. So, of course, these are only some counter-cyclical features, but you're absolutely right, which is that if there are government guarantees and market values of equity are just exploding with raising leverage in the first place and risk is low in the first place, some of this is going to create a little bit of pro-cyclicality. Second point, while book leverage, you could come up with measures of book leverage that are better in, like, say, a year before the crisis. Usually those measures do very poorly during the crisis because the market values collapse and the risk goes up phenomenally, but book values of equity and so anything you do with book values is not going to have anything about risk, first of all. But further, the book value of equity is just not written down by banks very aggressively. You know, they're just trying to not take write-downs as aggressively as they would like to do in the first place. And so my sense is there is this constant tension between market value of equity and book value of equity, which one to use. We are using market value of equity because we want to capture risk. We want to capture the fact that risk changes over time, which is something that book values can never pick up. If mortgages were safe in beginning of 2005, so Bear Stearns looks very healthy, but Bear Stearns looks not as healthy in March of 2007, the market value of equity, the change is going to pick that up. Whereas the book value of Bear Stearns is not going to reflect that in a very massive way because the losses have not been accounted yet, you know, on the equity in a very significant way. And the last point I would stress is that what these measures show is that had we capitalized the financial sector in fall of 2007, in August of 2007, when the shadow banking problems in asset-backed commercial paper broke out in the first wave, we would have needed only about $200 to $250 billion of capital to recapitalize the banking system because the risk had not gone up that much at that point. But we didn't do that. We let the system build up its leverage even further. So progressively, every month from August 2007 until August 2008, the capital shortfall needs just kept rising to higher and higher and higher and higher numbers. So our view is very limited. We are saying we don't want to be the super prescient guys who want to be able to predict a crisis in 2006. We are not trying to do that at all. We are just saying that at the time the market tells you there is stress in the financial sector and capital needs are high, let's at least recapitalize the system at that point. Because you would have seen even in August of 2007 that relative to beginning of 2007, the capital needs had gone up. 3 months from then, the capital needs had gone up even further. By Bear Stearns, the capital needs had risen even further. By end of June, the capital needs had gone up even further. But for 1 year, we basically ignored these market signals altogether because all banks look fine on regulatory capital standards. Like that's a meta theorem, right? Just no matter what regulation we design, banks look fine on that measure because they're going to optimize themselves fully to look good on that measure. So no bank fails because it fails the regulatory capital requirement. They're always well capitalized. In fact, they are surplus. So we think that market data is important because it tells you when the regulators are judging a balance sheet to be safe, but the fact that risks have changed are saying no. They're not getting wholesale funding in the market at all. They are very distressed. You need to figure out something about the recapitalization. But let me stop.
Okay, I think we're going to have to stop the official proceedings there. I don't know if you're able to hang on for a couple of minutes in case there are any one-on-one questions.
Sure, I can wait here. Yes.
But let's close by thanking Viral again. we'll try and start again on